One of the most profitable trading strategies that I've used for the past years is simply supply and demand. So what are supply and demand? Supply and demand is simply knowing when buyers and sellers are coming into the market and they're trading alongside them. Trust me, this is one of the highest win rate strategy you ever see anywhere. You can even go on Google to Google about this strategy right now called supply and demand. Trust me, this is one of the most profitable strategy to trade out there. However, if you don't know the right way to trade this strategy, you find yourself losing always. That's why I've created this video that will contain every single thing you need to know about trading supply and demand. You need to know what is supply and demand, the relationship between supply and demand, and support and resistance. And I'm going to break down every single thing for you in this video practically on my laptop so that you can see how I personally do my supply and demand trade, so that you too can implement that into your trading, personalize it to fit your own self, and then start making profit with it as well. So if you are new to crypto or forex trading, then welcome to my channel. Welcome to Forex, Crypto and Forex. On this channel, I mainly focus on sharing things on how you and I can make money trading the crypto and forex industry. So to make sure that you don't miss out on any of my forthcoming videos, don't forget to smash that subscribe button, like this video, and tell more if you down in the comment section at the very end of it. So without taking much of your time, let's get straight into today's video. Let me share with you every single thing you need to know about trading supply and demand levels to maximize your trading profit. So don't forget to join my Telegram channel. The link will be down in the description. Please do not use any link in the comment section. Do not reply to any comments giving you any link or any WhatsApp number. Those things have nothing to do with me. All my links are down in the video description. So if you want to join my Telegram channel, you can join from the video description. Over there, you can ask me any question at all that has to do with crypto or forex trading, and I'm going to reply to you immediately. So with that already said, let's get straight to today's video. Let me break down this whole course for you.
So hello guys, here's the list of every single thing you are going to learn in this video that will help you trade supply and demand the right way. So the first thing we are going to tackle is actually what is supply and demand, because before you can do something, it's more advisable you know exactly what that thing actually means. And the second, we are going to talk about what are L&H quality zones. So in case you don't know what L&H stands for, simply means what are low and high quality zones, because knowing the right zones to trade is the best thing ever. If you go trade low quality zones, you are likely to lose more of your trade rather than the other way around. Then the third thing is simply what is my time frame, which is my preferred time frame that I actually use to trade when trading the supply and demand. And then the other one is how I draw my zones, because if I should tell you the definition of high quality and low quality zones without showing you how I draw them, you might still not get them right. And finally, how I execute my trade. So these are every single thing we are going to learn in this video. So our advice is to watch this video to the very end without skipping any part. So with that already said, let's get straight. Let me share everything with you, starting with the first one on our list, which says what is supply and demand. So now to trade the first one on our list, which is what is supply and demand, let's switch over to a trading platform. Let me share everything we need to know about supply and demand. So the first thing here is simply what is supply. Okay, supply in simple terms simply stands for the market's position whereby people are willing to sell off their assets. So in case you don't understand, let me just use a text tool to give you a clear example. So supply is equal to sellers. So your sellers are those who are supplying, because let's say in normal term, for example, you go to market, the person you are buying the product from is the one supplying you the product. So it's simply your normal market mindset. Your supplier is the seller, meanwhile the demand is you, the consumer, who wants to buy the product. So that's a simple term. So for example, let me show you a chart here. So for example, if you want to trade and you see a market like this, like this, like this, like this, like this, and like this. When you look at this chart right now, what I just drew right now, you see that this area here, this top area here is where we call your supply level. This top is where we call your supply level, because this is where buyers meet the sellers. Because this below here is where we call the here is known as the demand level, because when people demand at this point, which is the buyers are at this point, meaning when they demand here, they are going to push this particular product from here, from this understage to this very top here. That makes it here your demand and here your supply, because people are going to demand the product at the lowest price and they sell it off when it gets to the higher price. So that is simply what supply and demand stands for. So supply and demand is simply, supply stands for where people are willing to sell off that product, meaning you'll be looking for a short position. On the other hand, demand simply means where people will be willing to buy that particular product, meaning you'll be willing to place a long or buy order at that very point. So that is simply all about supply and demand. So now the relationship between supply and demand, from my own knowledge, is that the multiple supply areas create a resistance area, and the multiple demand zones create a resistance area. So for example, take a look at this chart that I just drew here. Forget about any other thing for now. Take a look at here. You can see that this area here has multiple touches. 1, 2, 3, and then 4. So this one here comes together to make it a resistance area. Why is it a resistance area? It's simply because there are multiple suppliers at this very level here, which always push the market downwards, which prevents it from breaking above, keeping that place as a resistance area. So when there are multiple suppliers in a particular zone, that zone turns from a supply area to a resistance area. That's simply the relationship between supply and resistance. And on the other hand, when there are multiple demand on a particular zone, it turns that zone from demand level to support area. Why is it a support area? Because due to the high level of suppliers in the market, when they push the market downwards, they see a high volume of buyers at this particular point, so they support the price so that the price also doesn't break below a particular level. So in this way, you get to create support and resistance. That's why I always tell people that supply and demand is also a supply and demand is same as support and resistance. It's just that multiple supply areas create a resistance zone and multiple demand area create a support level. So now you understand what supply and demand means and how they are related to support and resistance. So now let's get into the main work on my time frame and the rest. So now that we've known what supply and demand is and how they are in relation to support and resistance, the next thing is simply what are low and high quality zones. So now going back to our chart again. So low and high quality zones are simply the areas with the most and least touches. So what do I mean by this? When you are looking at a supply and resistance level, for example, let me get my path drawer again. So you look at a market that moves in this direction, like this, create a zone here, came back upwards, came back downwards, went up, came back down, up, down, and then so forth and so on. So in this market here right now, what we call the high quality zones in this market are simply the areas that had the most touches in the market. So for example, let's take a look at this. If you look at this chart carefully, you realize that there are multiple touches at this very top here. You can see this top here had multiple rejections. Unlike these other areas, you can see this top had multiple rejection. This under here had multiple rejection. And then there is another area here which is smaller. Let me change that color to something different. Okay, this. So if you take a look at this market right now, you can see the top two yellow lines over here. Let me type them out for you to understand. Yeah. High quality supply zones. These areas are high quality supply zones. And on the other hand, this down here is also a high quality demand zone. So now the reason why only these two places are high quality demand zone is because this top here had multiple touches repeatedly, and this makes it qualify as a good supply area, because if the market comes here, there's a high probability that the market will reverse downwards. Unlike this middle level here, you can see the market trade up to this middle level, came back down again immediately. This is to show that this is not a good supply level because it had less touches on that area, unlike the other areas. Because if you look at it carefully, when the market tests this area, broke downwards, it tests this area, and then immediately after hitting that area, it immediately reversed downwards. But then on the second return from that area, it was able to break above it. That is to show that this area here, this former area here, this middle area here is not a good supply level because it wasn't able to continue its duty to prevent the market from breaking above it. So this middle area here is what we term as low quality support and resistance area, or low quality supply and demand zones. Meanwhile, this top here are the high quality, this top and bottom, which is the two yellow lines here, are the high quality supply and demand levels, because whenever the price gets there, it receives an immediate rejection which prevents it from breaking below it. So that simply makes it high quality. So when drawing your support and resistance or supply and demand levels, one thing to put in mind is that make sure that the levels you are drawing are really clear and are consistent in preventing the price from moving above it or below it. So if you should look at this area here, for example, you saw this price rejection at this area here, and then the moment the price traded to this area, you immediately place a trade back downwards again. You would have been caught out, because if you wanted to place a trade here, so for example, if you wanted to place a trade here, maybe you have to aim for the next resistance area. This to show that you have less movement even, and then probably it's a ratio of 1 to 1.05, which is a very poor trade, because how can you take a trade of 1 to 1.05? Meaning there's no profit at all. So the thing here in this market here right now is simply because this area here are not key resistance or supply areas, because the market easily break above them. So when trading supply and demand, make sure that you always focus on high quality zones that had multiple touches. If there are multiple rejection on these areas before, this ones will be seen as a short time frame resistance areas, unlike this top. So the top will now be used as a second take profit or second stop loss if you are using a trailing stop loss. But on the other hand, if you are able to wait patiently for the market to get to this top and place a trade at this top before, you would have gotten a decent amount of profit, because there's a high probability that the market will not break out of it, and then there's a high probability that you are going to make profit on the reversal, and you can see exactly that's happened over here in the market. So that's simply all about high quality and low quality zones. Now you know the high quality and low quality zone. The next thing to look out for is simply the time frame. Don't worry, we'll go into the drawing later. First of all, I want to give you the paper understanding of everything before we get into the drawing to make things more complicated. So now let's talk about the time frame. So when it comes to drawing supply and demand levels, I always advise you use higher time frame. So for a day trader, one thing I advise is that you should use the 4-hour time frame for a day trader. Personally, I'm a day trader, so I use the 4-hour, the 1 hour, and then the 15-minute time frame to determine my movement in the market. So if the 1 hour, 4-hour, and then 15 minutes are in agreement, then I'm going to place the trade. But if they are not in agreement, I'm not going to place the trade. So here's one thing you should notice about the time frames that I choose. The 4-hour time frame is one candlestick, and one candlestick in the 4-hour time frame is 4 candles on the 1-hour time frame, and the one candle on the 4-hour time frame is 4 candles on the 15-minute time frame. So what this is telling you that I'm literally dividing the market movement into 4. So when picking your time frame, pick consistent time frames that will actually help you see the market the same way regardless of the time frame you use. Because if you use time frames that don't actually work together, you are likely to confuse yourself. Like for example, imagine using 45 minutes and then 1 hour or 4-hour time frame. It won't work out, because 45 minutes here is literally dividing this 1 hour into inconsistent number. So when using your time frame, I always advise. So if you have to use any other time frame apart of 15 minutes, it should probably be 30 minutes or 5 minutes. In this way, you are going to get a consistent dividend of the market, so that the market will be divided equally. All candlesticks will stand out equally without having any sort of movement. So that's simply all about my time frame. So if you are looking for the best time frame to trade as a day trader, use 4-hour, 1 hour, and 15 minutes. But most of the time, make sure you take your trades on the 1-hour time frame, because I prefer the 1-hour time frame than the 15 minutes. But if you are a scalper, 15 minutes and 5 minutes are good for you. On the other hand, if you are a swing trader, then you can use the monthly, weekly, and daily time frame depending on how long you want to swing that particular trade. So that's simply all about low quality trade, high quality trade, and then also knowing the time frames that I personally use. So now that we are done with this, we're also done with this. Now it's time to move into how I draw my zone and how I execute my trades. So now, the final step, the main thing here is simply how do I draw my zones. Don't worry, we are not going to use this my hand draw zone to actually determine our zones in the market. So for that, let me just reset the chart and then get rid of every other drawing, get rid of drawings, get rid of indicators. So we are going to use the real market for how it is, because we are trading price action, so we need to look at the market structure first. So now when it comes to how I draw my zone, the first thing is simply considering the market structure. So what do I mean by considering the market structure? So for example, take a look at this market here, and you can see that I'm on the 4-hour time frame. As I already told you, that I'm more of the 4-hour time frame than any other time frame. So if you look at this chart right now here, taking a look at the 4-hour time frame, there's no clear let me change it to yellow so I can see everything. You can see that this market here is a ranging market. You can see that this whole place is a ranging market, as the market is unable to break below the support or the resistance area. So in this case, we know that we are about to trade at the zones, meaning we are looking for possible reversals to trade in this sort of market because the market is not trending. So in this sort of market, this where supply and demand actually plays the key role, because you get to understand that the market is unable to break above any particular zone or below any particular zone. So what you look at for in this area is simply trading from one zone to another. So now let's go back a little bit. So if you come over here right now, over here in this sort of market, the scenario is different. Because if you take a look at this market here, here is a trending market. You can see the market moved from this place to directly upward. So in this sort of market, what you look at for is simply possible buying push up because it's an uptrend. Don't worry, you are going to understand everything in a few minutes. So for now, let's first of all focus on drawing our support and resistance level. So now let me just get rid of this. Now take a look at this market here. Remember the first rule I said is simply when drawing your support and resistance level, only look at areas with multiple touches. So if you take a look at this chart here, where had the most touches in this chart here, looking at the 4 hour, it's simply this area here. You can see this area had multiple touches, which is 1, 2, 3. So this sort of area here is what I term as resistance area. Why is it resistant? Because there are multiple suppliers at this level. So for 3 consecutive times the market hits this area, it's unable to break above it. So whenever it hits here, you should be looking for a sell market depending on how the market moved there. And then on the other hand, let's take a look at the resistance levels. So to consider here, you can see here is a key resistance level here, this area here. Why did I ignore this old area? So now the reason why I ignore this area is because this old area here actually falls in lines with these other minor areas. And then when trading supply and resistance, one thing you shouldn't try to do is trading minor zones, because these minor zones can easily be broken when you are not aware. So these areas here are things you should most at times look to avoid. So your main target should be on this key resistance and this key supply and demand areas. So I'm going to leave this area unless it is active on the 1 hour time frame. As I already said, we'll be using 4 hours and 1 hour. So taking a look at the in this sort of market, you can see that you can easily draw your supply and demand levels. So now let me just mark them out for you to see. So here is your supply, where people are actually waiting to place sell orders, and here is your demand. It's your demand, where people are waiting to place buy orders. So you see it here, you see how simple it is to mark your supply and resistance level. So just marking it isn't the whole thing. The main thing is simply knowing how to trade it, and we'll be talking about that later on. So now on this other hand here, let's take a look at another thing on this other hand here when it comes to a trending market. So for that, let me move on to a different pair. Okay. So so here is a different market, and this is Australian dollar, US dollar, the Australian dollar versus United States dollar. So now let me look for a good trending market. Okay, good. So now let's take a look at this area here. So on this sort of trending market, the first thing you need to identify is that where is the market moving to, and if you look at it carefully, the market moved upwards. So this to show that this is an uptrend, and in an uptrend, the only thing you should be looking for to do in this sort of market is placing buy orders. So now when looking for support and resistance areas on your buy market, on your uptrend, is simply looking out for higher highs and lower highs. Why? Because the only way you are going to trade this sort of uptrend is waiting for the market to come back to retest one of those areas before you place a trade. Don't worry, I'm going to show you how you can use indicators to also help you get some of this done faster. So for example, in an uptrend, you came to meet the market at this area here. So assuming you came to meet the market at this area here, so what do you do at this area here? What you simply do is that you don't look to trade at this area, but what you simply do is simply getting your rectangle. All you do is get your rectangle to box the whole of this area, because you've seen the market that the market is an uptrend. So the only thing you look at for in this sort of market is waiting for the market to come and break above this former high that it created here. So here is a high, here is another high, and here is another high. This is what we call the higher highs. I often direct all of them as swing highs because they keep going higher and higher. So you see, this is simply what you mark at, and then wait for the market to retest it, give you a clear price rejection before you place an order. And if you should remove this rectangle and look at this market carefully, here is another good price pattern called the ascending triangle. You can see here is a resistance area, but here is a market pushing upwards. So anytime the market break above here, you should be looking for a good buy market. So now you see this is simply how you mark it on your uptrend. On your uptrend is totally different. You look at for where the market is heading to, and then you mark at that area and wait for a retest. And on a downtrend also, it just vice versa. So now let's take a look at another thing why you should wait for a retest. So take a look at this area here also. You see, this area here also. This another key area. You see, this one also is a under area if you are trading an uptrend, because if you take a look at the market, after the market broke above here, it got here and then came back below for a retest at this former zone, and then it moves upward, came back downwards into it, went upward, and then show a price rejection at the top, came back below it, and then you see all this whole period that is ranging here. You are not to trade this period. Why? Because the market is not moving into any clear direction. So you are simply understanding how you draw these zones, whether on your uptrend or on your downtrend. So as I said, on your uptrend, you look at some market rejection at the previous high. So the market should come back to test that previous high, reject it before you place an order. And then for a downtrend, also you wait out for the market to come and retest the previous low, break below it before you place your order. So that's simply all about drawing your supply and resistance level. So now coming back to the market we were, which market was I? Okay, it was on GBP JPY. So now that you've known how you can draw supply and resistance levels on both sort of markets, as I said, the first thing is looking at the direction of the market. For an uptrend, you should only look out for buy orders and avoid anything sell. For a downtrend, you should only look out for a sell order and avoid anything buy. And for a ranging market like this, the only thing you should be looking out for in a ranging market is simply trading from zone to zone, meaning trading from this zone to this zone, provided that you have a clear price rejection. So now that we've drawn this market on a higher time frame, now let's go to the lower time frame also. So for that, I'll go over to 1 hour. So for the 1 hour here now, here is where you actually need to be very careful. Why I like the 1 hour. So you see, as I said, you should be trading from zone to zone, provided that you see a price rejection. So now on the 1 hour chart here, you can see clearly at this area that there's no good price rejection here. And since there's no good price rejection here, meaning there's no reason why you should trade this market yet until you see a clear price rejection. Don't worry, I'm going to share with you some of the best price rejection patterns that you should look out for when trading these areas. So now, since there's no clear price rejection, what do you wait? You simply wait for the market to do what it wants to do. So in most cases, this market might decide to break above here, and then once you see it break above and come back for a retest, then you can place a buy order. But if it doesn't come back for a retest, you let it go. On the other hand, if you see a bearish rejection here, you can also place a sell order as well. So now you might ask, so what do you do when you see market ranging at this level without clear price rejection? So what you simply do in this sort of area is simply draw a minor area here. You can see for the past hours, you can see that the market is unable to break below here. So now based on how I trade, for me to trade at this zone level, I'll wait for the market to actually come from here, meaning the market will come from here, break below here. Immediately it break below here, and if I see a clear continuation of the downtrend, then I can place a sell order at this level. Then I can place a sell order at this level like this, and then trade it to this previous level here. So this is how I will trade it when I see it break below. Until it break below this minor area it's creating, I won't place any order. So hope you are getting the sense here, because this area here, this area you see here is termed as price build up or accumulative stage. So a price build up or accumulative stage is simply where the market gains enough power, meaning there's a strong competition between the buyers and the sellers. So during this process, the market will be gaining as much power as required for it to break above or below. So if the market should break below the previous low or break above the previous high, that is to tell you that it's a good time for a buy market. Meaning if you break above the high, means that the buyers have taken over the market and the sellers are weak. But if you should break below the low, it's simply telling you that the sellers have gained more power than the buyers, meaning the buyers are weak, so you can follow them to trade to that direction. That is simply the reason. So whenever you are trading support and supply and demand, and you see price build up like this, don't be in a hurry to place any order at that area. Wait for the market to break out of that build up area before you decide on which trade to actually take. So now the next thing is simply, after getting my zones and everything, how do I trade those zones what determines when I enter the market and when I get out of the market. So now here are the things that actually determine when I trade those zones and when I actually ignore them. So before I place any order at any zone, so for example, the first thing I look out for is a market movement in this order. So for example, like this. So for example, here is my, let me just get it straight. For example, here is my supply area. For example, here is my supply area. So once this is my supply area and then I'm seeing a price build up around this area, what I simply look out for is a market that will be moving in this direction. You see, the market keeps coming down, going, coming, going. You see, in this way, what I simply look out for is simply looking out for the ascending triangle, and this is how the ascending triangle looks like. So if you're a trader or you've been doing some research about trading, you've probably heard about this ascending triangle repeatedly. The ascending triangle is simply a market pattern whereby the market keeps shrinking. The more it goes, the more it shrinks. And if you look at it carefully, you can see that at this stage here, the space was big, gradually started shrinking. And in this sort of market, it simply shows that the buyers are stronger than the sellers, so they are pushing the market upwards. So I'll be looking forward to place an order the moment the market breaks out of the supply area. So in this sort of market, I'll be placing a buy order in this manner. So I'll be placing a buy order in this manner. So I wait for the market to break above, put my stop loss and then take my take profit very high, because by the time the moment the market break up like this, it's simply a sign that it's going to continue that upwards movement. So this is the first thing I use in entering the market, is simply looking out for ascending triangles. So now let's take a look at this chart if you can spot any of them. So if you look at this chart carefully, there is no place where you can spot ascending triangle. So now when you don't spot ascending triangle, what else do you look out for in the market? So another thing you can look out for is simply, so for this ascending triangle, we also have a descending triangle, which is opposite of ascending. But first of all, let's discuss how you place when the market is around the supply area. So after this ascending triangle, the next thing I simply look at for is simply a price rejection. So a price rejection is simply a market that moves in this order. So now let me get a drawer to actually get that for you. For example, I'll look at for a market that moves like this. Price, you can see the body, the market will create this body here, and then after this, then the market creates something like this at the resistance area. So this sort of what we call this is one of my favorite price rejection patterns. So for example, let me get this here and change the color to red, and then drag this to it like this. So for example, if you are trading and then you see this sort of shape in a supply area, then it's clear sign that the market is rejecting the supply area, meaning you should place a sell order immediately. The reason why you should place a sell order is because it shows that the buyers push the market up to this level, but they are unable to break above that level. So the market rejected the area immediately and comes downwards. So when trading with this pattern, here's the advice I have for you. Make sure that the price rejection at the supply area is in red color. If it's green, don't place an order yet, because that one is an indecision candlestick, meaning this green, if this area shows green like this, it can come downwards like this and then continue upwards movement. But if it's pure red like this, it's a clear sign that there's a serious price rejection here, meaning the market will push down and continue going down. So these are the two main patterns I use to trade at a supply area. So this is at a supply area. If there's a price build up, I draw my ascending triangle and wait for it to break out and then trade it. And then on the other hand, if it's a supply area again and then there's no price build up, and then I wait for this sort of rejection before I place any sort of order. So these are the two main things that you should always look out for when placing, because there are two types of order you can place at a supply area. One is a buy market. That's if the price should break above the supply area, you place a buy market. And on the other hand, it's simply looking out for a sell opportunity. For a sell opportunity, I always advise you use a price rejection like this. Or another thing you can actually use is simply an let me say an engulfing candlestick. So an engulfing candlestick is simply, for example, the market moved down like this. Let me give this one green color. Green. So for example, the market moved from the clone. I can clone this. Get another one here. So like this, and then like this. So I'm just telling you things you should look out for when placing an order. Good. So if the market should move up like this and then gets to this resistance area, in this sort of market, you should not be waiting to place a buy order, but be looking out for a sell order. So for you to place a sell order in this sort of market, there are two things you need. One, you need a price rejection like this, or on the other hand, you need what to call an engulfing candlestick, or some call it Meribosum or something. So an engulfing candlestick is a very big opposition candlestick to the one that moved upward. So once you see a candlestick like this, you call it engulfing candlestick because it should close above the previous candlestick, below the previous candlestick if it's a sell market, which is a supply area like this. So you see, once you see this sort of upward movement and you see a big candle like this that opposes the other candle, this is a clear market that the market is moving to this direction. Simply means that you can place a sell order immediately this candle closes, and then take your stop loss a bit above it, and then take your take profit way to the other key level. So you see the idea behind this is really simple. Look out for these three things. So here are the three things to look out for at the supply area. One, look out for the market to break out of the supply area and then you place a buy order. Make sure that you get extra confirmation. As I said, it should be an ascending triangle. And then on the other hand, and then when placing your order, always look out for the market to the sell order should be below, some pips below the previous low, so that you can be assured that even if the market should come back for a retest, you still be in the market until it comes back into your favor again, because ascending triangle is one of the key entries, like key entry confirmation that has given me some good amount of wins. And then on the other hand, you look out for a huge rejection like this, whereby the body here is times 2 to 3 the wick, because this week shows that the buyers pushed the market here, but then they weren't able to continue the upward movement, so sellers took it downwards. And then the other one is simply an engulfing candlestick line. So if the market should move like this consistently to the resistance area or the supply area, and then you see a big bearish candle like this is a clear sign that you should place a sell order immediately this candle closes, because the next candle that is coming will also be another big bearish candlestick that will continue the market to the resistance, the support or demand area. So that's simply how I execute it, and I also apply this to the other part of the market as well, which is the resistance area. So if I'm to trade at this resistance area, so for example, if I'm to trade at the demand area also. So this, for example, this is a demand area. If I'm to trade here, what I'll be looking for is actually what I call the descending triangle. So for the descending triangle is in this manner. So it's opposite of the ascending. So for this one, let me give it a different color. This. So for this one, the market moves in this direction. Boom. Rejection, boom, rejection, 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 rejection. You see, the more it goes, the more it shows you that sellers are taking over. And then the moment it breaks below here, bam, you know what to do. Is simply placing your order, placing your sell order immediately, and then having your stop loss like this. And then you'll take profits to the last place that the market has fell to before. So you see, this ascending and descending triangle are one of my favorite patterns when it comes to placing order. And at the same time, when looking out for this, in case this doesn't happen, then you look out for these other ones also. So know that it will be just the opposite. So for example, let me just get these ones here. So you've seen about let me just get it in there for you, so you also know about it. You have this here for a demand area. You look out for that. And then you can also look out for a pattern like this, whereby the market move from upside. It moved from upside down. So now let me just take this first. So let me just say the market move from the top level like this. Boom. Boom. Okay. Top level will be red. Yeah. Red. Another red. and then continue down with another red. Boom, like this. So in this sort of way also, you look out for what? An engulfing candlestick like this. But this other time around, it should be a bullish candle pattern, which is green. So you look out for something like this. Immediately this one opens and closes there, you place your order immediately. Always make sure that an engulfing candlestick should close below above the previous candlestick if it's at a demand level. But if it's at a supply level, it should close below it. So this one here is the opening of this one. So here, this top here is where, let me get an arrow to indicate that for you. So here, arrow maker, here is the opening price for a sell market, and here, and this down here is the closing place. So always make sure that at a supply level, the red candle should close below the previous green candle, and at a demand level, the price should close above the previous one. So for a demand level, here is the opening price. So here is the opening price over here. So you can see the difference. So here is the opening price. So the difference is that for a sell market, at a supply level, the opening price should be above, which is for a red candle, the opening price is at the top and the closing one is below. Whilst for a bullish market, the opening price is below and then the closing price is at the top. So look out for all of these patterns if you are trading at these areas. If you don't sight these patterns, leave the market alone. So now after sighting these patterns, another thing you can actually use to help yourself out is simply using what I call, let me get rid of all drawings, remove all drawings. So another thing you can look out for is looking out for this indicator. Let me just show you. Moving average exponential. So another thing I do is that I use the moving average exponential, which is a 50 moving average exponential. So I'm not going to show you how you can set up this indicator in this particular video. No, I've already created a video on how you can set it up, so you can go watch it out. And I'll be linking to that video down in the description.